So let us start the class and we'll try to solve this question first, how to read a balance sheet. But before we proceed to this question and before we answer this question, we should know what is balance sheet and what are its components. See, balance sheet is a broader term which is used almost with or parallel with the financial statements. When you say balance sheet, you say that it is a balance sheet plus profit and loss account or profit and loss statement plus you have annexures. Annexures to what? Annexures to the profit and loss and to balance sheet. Everything I will write and you will understand, and I request you to keep a pen and paper notebook with you. We follow Gurukul style here in our classes also, and if you see my courses, everything I am writing so that you also write. When you write, you understand and you keep it in your mind for a longer time. That is the Gurukul style. So now here we will try to prepare one balance sheet, because unless you know how the balance sheet is prepared, you will not be able to read it. Are you getting me? So we'll prepare one balance sheet, then only we'll jump to some practical live examples so that you can understand it clearly. Now I have taken two parts. One is the balance sheet and the other one is the profit and loss statement. Simultaneously, we will understand both of these because both are interconnected to each other. Few items are coming from profit and loss to balance sheet, and the others are coming from general accounting. Now, balance sheet is always prepared as on date. As on date means as on a specific date. Let's say 31st March of any year. This is a position. This is a position of assets and liabilities as on this particular date. Whereas profit and loss statement give you picture for entire year. During entire year, what were the sales, what were the expenditures, and what profit you have earned. This is for complete year, rather than the balance sheet which is prepared as on a particular date. So let's say if you are preparing on 31st March 2025, so whatever stock was there in the balance sheet, in hand, stock in hand, that will be reported in the balance sheet. Let's say on 30th March, stock was 50 lakhs, but in single day they have dispatched more than 40 lakh goods. So the stock will come here 10 lakhs balance, because out of 50 lakhs, 40 is sold in a day. By the time 31st March came, now stock is only 10 lakhs. Now understand from a layman that Mr. A wants to start a business. He will need various items. Items in the sense he will need funds to start a business, of course. He'll need funds for, see, when you start a business or you are about to start a business, you will need funds for land and building. Of course, you will need a land or a building where you can set up your plant, machines. Then you will require funds for plant and machinery. You will require funds for day-to-day activities, for salaries, for electricity, for raw material, everything. For everything you need funds. Now let's assume Mr. A has 1000 lakhs or 1000 crores or 1000 rupees, 10,000, whatever it is. Just understand the concept. Forget about the denomination. Okay, so he's having 1000 with him. Now what he'll do, he will invest that amount in the business. and that will be known as capital. So this will be coming in the left side 1000. Okay. Now understand the parts of balance sheet, how the balance sheet is divided. Now let's say before that 1000 is invested in plant and machinery and land and building. Okay. Capital is reported in the liability side of the balance sheet, and whatever assets you have, it is on the asset side. Balance sheet has two sides. One is the liability part, which is on the left side, and the other one is asset side, which is on the right side of the balance sheet. For understanding purpose, because this is a T shaped balance sheet, left is liability, L for left, L for liability, and asset is your right. You have right on your assets, so it is in the right side of the balance sheet. This is a T form. You have other form also, we'll discuss when you join our courses. In normal scenario, do you think that whatever funds Mr. A was having would be sufficient to run the business, to start a business, to purchase the required fixed assets or current assets? No. In the normal cases, you means Mr. A may have to approach the outside environment for funds, and that could be in the form of what? It could be in the form of long term funds, that means term loan from banks or unsecured loan from friends or relatives. Then you may have to approach for short term funds, which may be in the form of suppliers credit, that is creditors, or you may approach a bank for CC limits also. Okay. For the time being, let us consider only the capital for understanding of balance sheet as of now. Let us assume that out of 1000 which he was having, he has purchased plant and machinery worth 600 lakhs, whatever. Then he has invested on land and building 200. Then 800 is removed here, it is invested here. Out of remaining 200, he has purchased goods worth rupees 150, and he's left with 50 only. So both side of the balance sheet is matched. 100 has been invested here and 1000 has been invested on this side. See, whatever funds are coming to this side of the balance sheet, please understand very carefully, this is very important point. Whatever funds are coming in this side of the balance sheet, they get invested in the right side of the balance sheet. Long term or short term doesn't matter, they will go into the right side of the balance sheet. The company will either purchase long term assets, which are known as long term uses, or it will go for short term uses. Okay. Now, since that company is into the business of trading or manufacturing, whatever, so what he'll do, he has purchased goods worth rupees 150. Whether he is going to keep it with him? No. He'll process it, he'll sell it. So let us assume, let's say the company has sold entire stock of 150. Okay. And for how much it has been sold? This is a cost. It has been purchased by the company at cost. Now, after adding their margins, they will sell these goods. Let's say they have sold it for 200. They purchased it for 150. So, what will be the profit? It will be 50. Are you getting me? The company has sold entire stock of rupees 150 for 200 lakhs, and this stock was purchased for 150. So sales minus purchases or expenses, we are not going deep into that, it is profit. So after selling goods worth rupees 200 lakhs, the company has made profit of 50. Now how this profit will affect, how this stock will affect the balance sheet, let us understand. When the company has sold entire goods of 150, so this should not be in the books because these goods are gone. It is gone, completely gone. So what we'll do, we'll remove this. Okay, stock is gone. Now what the company has done, they have sold it for 200. So this has come in cash. So cash position will improve. It will be improved by 200. Already the company was having cash of 500. Now 200 they have sold goods. So it will be 250. Okay. I have shown in this way so that you can understand what has happened in every transaction. So now one item is remaining, that is profit. The company has earned profit of 50. This is also coming to the company, and this is to be used by the company's promoters. This is for the promoters. They can withdraw this amount. It is a profit because purchase amount is gone and they are left with 50. So this amount will come in the form of reserves and surpluses or profit, whatever you can say, it will come as 50. So now earlier the total of balance sheet was how much? 1000. It was matching both sides. Now what happened? We have made certain adjustments. Now this side has become what? It is now 1050. And let us total this side also. 6 to 8 and 250. This is also 1050. So now you understand that every transaction which is happening in a business, it has two effects. The effect may be on same side of the balance sheet or opposite side of the balance sheet. Let's say the company has sold the stocks, so the stocks will go, cash will come. Okay, now let's take another example. We'll continue this case study also. Let's say the company has purchased goods worth rupees 300. But you will say how the company can go for 300 purchase. Now what the company has done, they were falling short of the funds, so they approached the bank and they have gone for a CC limit of, let's say, 50. So with the help of this 50, they purchased stock of 300. 250 they have utilized the cash position. Okay, now the cash will become how much? 250 minus 250, it is 0. And earlier the stock was 0, now it has become 300. Now again you will see that both sides of balance sheet are again matched. You can just check it. It is 1100 on this side, and again on this side it is 1100. Every transaction is having two effect. Now let us continue this example. This will keep it as 0 because it is 0 now, cash balance. Now what the company has done, the company has sold goods worth 200. Okay, so stock will reduce. 300 minus 200, 100 is left. 200 they have sold goods, so they will go to the sales side of the profit and loss statement. Let's say the company has sold it for 250. These goods were purchased for how much? 200. And let us say that expenditure incurred on such goods may be, let's say, 10. So what will be the revised position? 250. Now out of 250, 10 is spent on expenditure and 200 for purchase. So they are left with profit of 40 lakhs. Now let us see how the changes are done in the balance sheet. So we already made changes to stock position. 300 was originally. Now they have purchased goods, sorry, they have sold for 200. So this stock will be reduced by 200. So now they are left with 100 only. Now we have cash position 0. What happened? They have sold goods worth rupees 250. So this 250 will be coming as cash and it will increase our cash position. What will be the revised cash position? It will be 0 plus 250. Now one more thing, they have paid expenses of 10. This will also go from cash balance itself. So now the cash balance will be 250 minus 10. So final figure will be 240. Now the company has earned a profit of 40 lakhs. So this profit will go to whom? This will go to the promoters. So already they were having profits of 50. This will be added with another 40 what they have earned. Okay. So now let us total both the sides. It will come as 1140 on both sides. Are you getting my point? The point is that every transaction will have two effects and it will be reflected on either side or same side of the balance sheet. So this is the overall idea of how the balance sheet is affected or balance sheet is prepared. What is the significance of profit and loss account, how the items are moving and affecting the balance sheet. Now it may so happen, just take one another example to make it clear, that the company has purchased or sold goods worth 50 for, let's say, 100 lakhs. Okay, 50, the purchase price was 50. Now they are left with only 50. Expenditure, let's say another 10 they have incurred, and now the profit is 40. Okay, now what will happen? Till date, till in our examples we were doing that entire money which is coming from sale was cash and we were adding cash to the balance sheet. Now it may so happen, or rather it always happens, that some part of the sale or entire sales are on credit. The party may have asked for credit period. Now see, I'm not going to give you the money. You raise invoice, and from the date of invoice or from the date of receipt of goods, within 30 days from that date, I'll pay the money. So what will happen? Let's say out of this 100, only 50 has come in cash, another 50 is outstanding. So this 50 which is outstanding, what it will become? It will be debtor. Sorry, it will be debtor of 50. Now cash position will be affected by only 50. Now again if you total, then this total will be matched. One item is pending, sorry. This profit of rupees 40, ultimately they have earned the profit. The money will come one day or the other. That is assumed in the accounting process. It is known as accrual based of accounting. So ultimately you will add profit of another 40 in the balance sheet. So now you will be finding it that again the both side of balance sheets are matched. Are you getting the point? So in this way, whatever I have told you, you can just understand the balance sheet in a simple way, that when the goods come, it comes in the shape of stock. When they are going out, either cash will come or debtors will appear. Now, let's say the company says that on 31st March, I don't have enough stock because it was sold. So, he cannot get rid of by just saying this that the goods were sold. You have to see that either cash balance, bank balance will increase, or there will be debtors. Now, in few cases which are where the CC limit has already been sanctioned by the banks, they find that there is no stock or there is no debtor or debtors are on lower side, the customer giving plea that I have sold goods on the last date or the last week of the financial year. So it is not at all an excuse. You can just cross verify that if stock is not there, then you must have sold goods on credit or you must have sold goods in cash. Either way, the balance sheet will be affected and the current assets will increase. So as of now, just understand what is the picture of balance sheet. Whatever funds are coming in this side of the balance sheet, which is known as the liability, which is on the left side of the balance sheet, these are sources. And sources can be long-term sources or short-term sources. These sources are invested in the right side of the balance sheet, which is known as the asset side of the balance sheet, on which the promoter has the right. So this also may be long-term uses or investment, or it may be short-term uses or investment. We have to understand what kind of funds are coming to the company and for what purpose they are using those funds in the balance sheet in their business. Long-term funds, if they are used for long-term uses, okay. Short-term funds, if they are used for short-term uses, okay. Or long-term funds can be used for short-term uses, or short-term funds can be used for long-term uses. These are all the general questions in addition to the questions like whether we can do vertical analysis or whether we can do horizontal analysis of a balance sheet, whether the promoters can invest their funds in the current assets, or whether CC limit can be used for purchase of a fixed asset. These all are part of balance sheet we will discuss.